Hey guys, my name is Allison. I'm a CPA over in Capitola, California. Just got done from a beautiful run on this Sunday morning. It is June 2025. I feel like it's important to date stamp these things because the tax law changes all the time. It's planning season over here at the firm. The tax season, for the most part, returns are done. The dust is settling. Taxpayers are coming to me going, okay, we got to do it better in 2025, or hey, 2024 hit me harder than I thought. Where did I leave money on the table? And one thing that I have seen multiple times this week come up is the SEP contribution versus the 401k for employee shareholder S-Corps. So this is a strategy specifically for you are an S-Corp, you are the sole employee shareholder. Let's go through two scenarios. And a lot of times the SEP is a really popular option because it's an after the fact option. The SEP is great because you don't have to fund it until the due date of the tax return. That's not going to be true for our 401k. So let me walk you through this. Under our fact pattern here, we've got the remaining pass-through income of $200,000. So this is what ends up being on our K1. Total earnings from the company, let's say $300,000. So under option one, and this is the one that your CPA is going to come to you with when it is March of tax season, they're going, hey, you know what, you could fund a SEP and it's going to save you money, and you're going, great, let's do that. The SEP contribution maxes out at 25% of the W-2 income for the shareholder, so $25,000. So it's going to reduce your pass-through income. So under this scenario, we've got taxpayer paying taxes on 100K of W-2 income, and a net 175 from the pass-through. Total taxable income, $275,000, assuming 20% tax rate, $55K. Now, if this same taxpayer had been a little bit more prudent about planning throughout the year, they could have set up a 401k plan, and then of this $100,000, they can go ahead and do their employee deferral just like any other employee. What's nice about this is not only does this not have any effect on their ability to do profit sharing or SEP contribution, this amount is not subject to payroll taxes. So not only do we get the income tax savings, but we get the payroll tax savings. Next, we're still able to do a 25% match of that W-2 income. In this case, we're going to call it profit sharing. And so we get the same deduction, same reduction from net income from the business. However, now our total taxable income is going to be less because we had that employee deferral. So over here, you can see the tax savings isn't all that substantial. We're saving about $4,700 in income taxes, but we're also saving about $3,600 in payroll taxes, even more, depending on the state that you're in. So our total savings is almost about 83 just by having a different retirement plan and by being a little bit more, having a little more forethought throughout the year, reaching out a little sooner rather than later. This amount would need to be funded before the end of the calendar year or your tax year. Now, let's say you've got an employee. If you are going to do a 25% match for yourself, you got to do it for that employee too. So, you know, if you've got a spouse working for you in your S-Corp, this is another great option for them. It might not be the right fit for everybody. The other thing to consider is if this is your side hustle and you participate in another 401k, this limit is for all of your plans combined. So there's no double dipping. It's not, I'm going to max out this 401k and this 401k. You get one 401k match. Anyhow, wanted to share this tip with you. If you have any questions, there's a lot more that goes into this. This is a pretty simplified analysis, but I just wanted to share it because it was just too good not to share. All right.